Okay, so before I get started, I just want to remind about the disclaimer that everything being shown is for educational and informational purposes only. Everything here is based on my own individual circumstances, market conditions, and personal risk tolerance, and that you should conduct your own research and understand that markets have risk and that you're solely responsible for any trades or investments you make and the consequences thereof. So what I'm going to do is I will do a quick walkthrough of my Etrade account. As I mentioned in the last video, I set up this account just to get a better understanding of what Etrade had to offer. Since I knew I had some friends that had an Etrade account. My main investment is done with Fidelity, but I wanted to see what Etrade had to offer just to see if there were any tools or anything that I could find useful um, on this journey. So as you can see here, I had only put $1,000 in. I just wanted to use the tools. I didn't really have anything planned for it, so I bought a CD. This CD was a 5.25% that expires. Um, Sorry, I use the term expire just because of options language, but 925 is the date that will come due. All right, and my goal right now is to kind of add another $1,000 so that I could perform Model One in this account. Use the other $1,000 for the TQQQ slash UPRO strategy, and I probably won't do uh, another treasury or CD since it's only a 2000 account and it might take up a bit too much, but we'll see. I'm still waiting for the verifications to come through so that the money shows up. Okay. But basically, what I do is if I was buying a treasury or a CD, I would go to market ideas, bonds, and CDs, and okay, give this time to load up. All right, there you go. And what I've been doing is I haven't been focusing on any other corporate or municipal or any other bonds. I really look at these two lanes right here, the CDs being offered and the US Treasuries. And depending on, like, I can't do it in this account, of course, but in my other accounts, what I typically do is every month I would go in and I would get some type of bond. Um, in this case, because the CDs are at 5.5%, I only look at the 3, 6, 9 in the year. And every month I go in and I buy something. All right. Um, this is a 5.5%, so this has gone up a bit. So if I look at that CD, this is probably one of the ones that I would buy. So JP Morgan CD, 5.5%. I know JP Morgan, they have a lot of callable CDs, and I don't worry too much about if it's callable. If it gets called, then I get my interest rate for the time period. It might as well be like a 3 month CD or whatnot, um, because I'm selling these on a monthly basis, so it doesn't really matter to me. So I would buy something. I do something on a monthly basis, so that puts me at maybe $12,000 for the year, and this is just to um, continue to get practice and continue to build a habit of this is what I would do. Okay. For the Model 2 and the covered call strategy, what I really like about E-Trade, if I go to market ideas, you're not going to see it here because it's already on this. So if I go to options, actually I want to show you the full view. So let me go back here a second and then go to the main market ideas. Okay, hold on 1 second. Let's see if I click options, if it gets me there. Okay, there we go. All right, so I like their suite of tools that they have. So many years ago, when I started looking at this stuff, stocks and so on, at more in depth, I utilize backtester tools, all right, to look at the historical trends, try to come up with a idea that I believe works for me, model it, and then just trade that system. Okay, so I was very impressed and surprised when I saw this options income backtester included as just part of being a customer. Unfortunately, it doesn't have the symbol that I'm really looking for, TQQQ, but it does have QQQ, which is, at the end of the day, I've mentioned this in the last video. I love QQQ. And so everything that I do is basically based on, how can I follow it? How can I get the same results, etc. So it doesn't have TQQQ, but it has QQQ. And if I do a search on this covered call strategy, it shows basically it's kind of like a what if you had done this for historical purposes. All right. So right now we see covered call with a 0.35 delta with a 30-day to expiration. That seems to have been the strategy that worked the best. This strategy returned 6.3%, but the stock market return was really 7.7%. All right. So in reality, if you had just bought QQQ and left it, you would have done better than performing a covered call strategy. All right. The drawdown would have been less. So you see there was a drawdown of 29.3% for a covered call strategy, whereas the stock drawdown was 35%. So when I talk about drawdown and so on, what do I mean? Let's look at this chart just so that you can see it a little better. All right. So the kind of the orange one is the covered call strategy, and the blue one is regular QQQ. So as QQQ goes up, you'll see that the covered call strategy slowly trails it. It doesn't go up as fast. Okay. However, when it goes down, it doesn't necessarily go down as fast either, right? But it does happen to go down. Okay. So that's the reason why I like to maintain a healthy amount of cash, especially if this is happening at 3 times. That helps to offset what's going on in terms of in a down market. Okay. Recently, these past few months, so let's see here, maybe starting in maybe about May, the market basically took off. All right. And because of the catch up aspect of it, the cover call strategy is trailing. It's trailing the just stock market strategy right now. And that's okay. When I look at the models, what I'm really trying to achieve is, the results over a rolling 3-year period. So I'm not concerned about I know it will catch up, and I know that I'm creating income along the way. So I'm not totally bothered by that. Okay. So this is a 0.35 delta and a 30-day expiration. One of the things that I do is I try to look at it from a 60-day expiration perspective. The reason for 60 days is options have this thing called decay, whereas the longer you hold them, um, the lower the value is, unless there's an increase in price. And I know I'm simplifying it a bit. There are videos out there that explain it, and maybe one day I'll do one. But um, I look at anything within 60 days, not exactly 60 days, but anything within, and try to come up with um, what should I go after. All right, and I'll show that to you now. So if I go back to options, there's this other tool that they have, which is called the Options Income Finder. So if I click on the Options Income Finder, all right, so now I put what I'm really going after in here. It's a covered call. I try to get a 6% premium. The way I look at it is, hey, is there something that would give me 3% a month if nothing happens in the market whatsoever? All right, so I use a 6% premium, and then maximum days to expiration. That's where I put the 60. Then I do a search. All right, so the search comes back with 4 results. The way I look at it is I pick the earliest one, the earliest expiration. A quick return, money in the pocket, equals a higher annualized rate of return. They don't really show the rates of return here within under the 60 days, but as you go out further, you will see the rate of return. They could be in the 80s. Actually, let me give you an example. So let's say this was 120 and 90. Oops, nothing. Oh, nothing. Let's remove the 120. Let's see what's out there. All right, so you see the static return and annualized return. They show values now. So this is saying if nothing happens in the market and everything remains the same, which is what the static return is, it just remains the same, then you would have made a 32% profit annualized, right? So it's basically take the profit that you have and based on how many days you had it for, just kind of see what that would look like for annual rate, kind of like the CDs and the treasuries and your savings account. When they give you a rate, they say okay, 5%, but that doesn't mean that if you held a 3-month CD you would get 5% back. It means that if you had held that CD for an entire year, you would have gotten 5%. But if you're only holding it for 3 months, then you divide 5% by 4, and that's what you're actually getting. Okay, so this is if nothing happens. This is if the covered call strategy ends with and you'll have to watch a video about or understand a little better what happens when a stock gets called from the covered call strategy. But if that happens, and if you determine that I no longer want to keep this, and the other person who you sold the call to decides, hey, I want your stock, this is the result. If they were able to take it from you, this is how much you would earn. Okay, but either way, when I do my strategy, I just do maximum of 60 days, and if I pick the earliest date. However, if there's a situation where like this one, this has 3 for August 18th, I would usually go after the highest if called. All right, so if I click on this and I say trade, all right, This is an initial entry, sell call and buy the stock. So I would click on sell call, buy the stock. If I already own just the stock, I would just sell call only. Okay. All right. So the thing, let's see if it, okay, I think it shows values. Okay, so the reset hasn't happened yet. One of the things that I've noticed with Etrade is that, you know, if you try to do this at a certain time, it might be a little later, but maybe just before the market opens. Sometimes it doesn't, this shows up with a bunch of zeros, and then you can't do it exactly the way that you want to do it. But in this case, it seems like the numbers have shown up. So and you don't have to worry about that if it's during the trading day. These automatically change anyway. So if I click on this one, the ask, all right, this is what the percentages were really based on. Okay, it fills in the number here, and with that problem that I mentioned in terms of zeros and making sure that you get the right rate, just ensure that, hey, this is the current stock price. All right, there should be a number in here. In this case, it's $2.68, which means when you multiply that by 100, it means that when I do this transaction, I generate $268 in income. All right. So this number, whatever this number is, should be equal to that number minus this number, and this number should not be zero. Okay. All right. And this entire transaction is going to cost $3,783. Right. So that's why in the video when I discussed model 2, I also mentioned that you should have a higher account, because you do a couple of these and then you need to maintain the 40% cash, etc. Then it just has a higher capital requirement. Okay. Obviously, in this case, I only have $1,000 in here, so nothing's going to happen. I'm just going to click on preview for fun. I have insufficient. I won't have sufficient in here until later. So I'm just going to be doing the regular model 1, you know, and building up the account and just having fun, just watching what happens in the markets. Okay. So that's it for today.